morning, everyone, and welcome to the Global Financial Stability Report press briefing. I am Randa Elnagar of the IMF's Communications Department. We have with us here today Tobias Adrian, Financial Counsellor and Director of the Monetary and Capital Markets Department, Fabio Natalucci, Deputy Director of the Monetary and Capital Markets Department. Tobias is going to start with some opening remarks, and then we're going to take your questions. Tobias.
Good morning, ladies and gentlemen. Today, we are pleased to present the latest edition of the IMF's Global Financial Stability Report. Along with Chapter 1, which we are releasing today, I'm sure you'll be interested in the additional 4 thematic chapters of the GFSR, which will be released next week. The COVID-19 pandemic has triggered a severe global economic crisis. Policymakers have taken bold, unprecedented action to protect public health, contain the immediate economic damage, and safeguard the financial system. For the moment, near-term financial stability risks have been restrained thanks to extraordinary monetary policy and massive fiscal support. That dramatic action has stabilized global financial markets, boosted investor sentiment, and maintained the flow of credit. Critically, decisive policy support has helped prevent the destructive macro-financial feedback loops that were so prevalent and so pernicious in the financial crisis more than a decade ago. However, some pre-existing vulnerabilities are now intensifying, representing potential headwinds to the recovery. Risks to growth are still tilted to the downside. The probability that global growth will fall below 0 in 2021 is close to 5%. This tail risk suggests that the economic future remains precarious amid huge uncertainties. Moreover, there's a risk that the recent policy actions may have unintended consequences beyond policymakers' stated objectives. If persistent, for example, there's a persistent gap in financial markets where rising stock market valuations, despite the recent repricing, and the weak performance of the real economy are disconnected. This gap is hopefully going to narrow gradually as the economy regains steam. But if the recovery is delayed, for example, if it takes longer than expected to get the virus under control, then investor optimism may wane. Policymakers face a trade-off in their decision-making between the support that is needed today and the implications of rising vulnerabilities for growth in the medium term. Policy measures have allowed firms to cope with cash shortages that they experienced during economic shutdowns by taking on more debt. This additional borrowing has helped avoid a wave of bankruptcies at the early stages of the crisis. But it has also led to a further increase in corporate debt burdens. Many firms already had very high levels of debt before the crisis, and now indebtedness in some sectors is reaching new highs. This means that solvency risks may have shifted into the future. Renewed liquidity pressures could easily morph into insolvencies, especially if recovery is delayed. In addition, the resilience of the banking sector is likely to be tested. The banking sector entered the COVID-19 crisis with stronger capital and liquidity buffers than at the beginning of the global financial crisis. The success of the reforms undertaken over the past decade has allowed them, so far, to be part of the solution rather than part of the problem. Banks continued to provide credit to businesses and households during the pandemic. Nonetheless, In an adverse macroeconomic scenario, our analysis shows that some banking systems may suffer significant capital shortfalls. A large number of firms and households will not be able to repay their loans, even after accounting for the currently deployed policy measures, and their profitability will falter. There are also concerns about the non-bank financial sector institutions, which now play a growing role in credit markets in advanced economies, including its riskier segments. They have managed to cope with the pandemic-induced market turmoil thanks to policy support, yet there are evident fragilities in the sector. The increased links between corporates, banks, and non-bank financial institutions imply that, at some point, fragilities could spread through the entire financial system. Conditions in emerging and frontier markets also require policymakers' attention. Some emerging markets and low-income countries face financing challenges. The easing of global financial conditions has generally improved the outlook for portfolio flows to most emerging markets. However, some low-income countries have still not regained access to capital markets. Some of them are so heavily indebted that they may face distress as they confront borrowing costs at prohibitive levels. Looking ahead, policymakers should carefully sequence their response to build a bridge to a sustainable recovery. As economies reopen, monetary policy should remain accommodative to sustain the recovery. Liquidity support should be maintained even if its pricing should be gradually adjusted to encourage the return to market funding. A robust framework for debt restructuring will be critical to reduce debt overhangs to resolve non-viable firms. An extension of multilateral support to low-income countries that face financing difficulties will be important. The immediate policy agenda should be mindful of one overarching objective: the transformation of today's carbon-intensive economic model and the transition to a greener, cleaner, and more stable economy. After the pandemic is under control, a robust financial sector reform agenda should focus on rebuilding bank capital buffers, strengthening the regulatory framework for non-bank financial institutions, and stepping up prudential supervision to contain excessive risk-taking in a lower for longer interest rate environment. Thank you very much. Now we'll welcome any questions you may have.
Thank you so much, Tobias. We have a few questions coming in online and through WebEx. So we are going to start with Nikkei. Takeshi Kawanami is asking, the shape of the global banking sector is not so bad, but in euro area, private banks has had huge non-performing debt since the European debt crisis in 2010. And European private banks have a lot of credits in South America that has a risk of debt crisis. So how do you assess the European banking sector?
Yeah, thanks for this question. We are publishing in this Global Financial Stability Report a global bank stress test. And indeed, the global banking system entered this crisis with much higher capital and liquidity levels than was the case at the eve of the global financial crisis in 2008. So in our assessment, overall, globally, the banking system is safe and can absorb future losses, even if the pandemic were to last longer than expected and if downside risks were to realize. However, there's a weak tail of banks in some regions and in some segments of the banking sector. So in particular, there are some charts in the GFSR that indeed show that banking systems in Europe are somewhat more vulnerable than the global banking system on average, and banking systems in emerging markets are also somewhat more vulnerable. Some of these vulnerabilities in those banking systems is related to the position with which the banks entered into this terrible pandemic. And so these pre-existing weaknesses are carried over. For example, some banking systems had high NPL ratios to start with. Furthermore, some countries are hit harder than other countries, and of course the banking sector performance reflects the economic developments in those countries. Furthermore, in some countries, particularly in the euro area, interest rates are expected to remain very low for a very long time, and the yield curve is very flat for a very long time. And that tends to lead to a compression of net interest rate margins of the banking sector. So as we are moving into the recovery phase, and hopefully economic activity will resume around the world, including in Europe, we do expect that banks are going to rebuild buffers. But of course, a profitable banking sector is needed to rebuild those capital buffers, because capital are retained earnings on banks' balance sheets. And so profitability challenges certainly present a headwind to the recovery of bank capital buffers, which should be used in this crisis, right? I mean, bank capital buffers are there to be used in times of crisis, but then the rebuilding will take more time where profitability is low.
Yeah, so maybe one thing to add is, like Tobias mentioned, the non-performing loans in European banking sector. That has been one of the structural issues that European banks have to deal with, together with the low interest rate environment and profitability challenges. So it's important now. A lot of steps have been taken to address NPLs in Europe. Those were important steps taken going into the pandemic, so reduction in NPL across a number of countries. So going forward, it's important that banks continue to have a comprehensive strategies to address NPLs, strengthening the resolution regime in Europe, and also continue to have secondary market liquid where these NPLs can be disposed at market prices.
Thank you very much. We take now a question from Greg Robb from MarketWatch. For the US, what sort of prudential regulation do you have in mind to contain risk-taking?
Yes. Thanks for that question. It's of course a very important question. The sell-off that was triggered by this pandemic in March, it started in February and then accelerated in March, and then slowed down in April and May as central banks intervened. That sell-off uncovered a number of vulnerabilities in the non-bank market-based financial sector. In particular, money markets dried up to some degree, and money market funds, some of them became vulnerable. So that will certainly be one area of focus. Secondly, we saw a dry up of liquidity in treasury markets in the US, but also in benchmark sovereign markets in other countries around the world. And so these are the safest assets and the most liquid assets, and so a dry up of liquidity is certainly a concern to be looked into going forward. Furthermore, margins increased very rapidly in some market segments, which is another area of concern. And then finally, in asset managers, liquidity mismatches and risk transformation continues to present the vulnerabilities. So these are all focus areas in the non-bank financial sector. In the banking financial sector, of course, as I mentioned earlier, the banks entered the crisis with high levels of capital and liquidity, and we expect some of those buffers to be drawn down, and it will take some time to rebuild those buffers once the economy is recovering. So to answer your question, you basically have to look at different segments of the market system, and prudential regulation in both the banks and the non-banks will continue to play a major role going forward.
So maybe if I can add, the focus of concern for non-bank financial institutions, one has been the liquidity mismatch. That's one vulnerability that come to the fore during the stress in March. Obviously, with the help of policy support, the vulnerabilities, the asset management industry has been able to address those. But there are other vulnerabilities that we have highlighted in previous financial stability reports. One of them is that some of these non-bank financial institutions play a larger role in credit markets, particularly the riskier segment in advanced economies. So it will be, we need to monitor how they will handle the recovery. Other possible vulnerabilities are, one, we have seen that there's been increase in asset correlation. That means that if there is a shock, the shock could propagate across the non-bank financial institution at a faster speed and become potentially an amplifier. Another, it's incentives going forward. In the very low interest rate, very low volatility, with returns starting to compress, there is a risk that there will be an incentive to use financial leverage to boost this return. So that's something that it's worth continue to monitor going forward. And finally, is the interconnectedness that Tobias had mentioned between the banking sector, the non-bank financial institution, and the corporates, and the extent to which, if there is an additional resurgence in stress in market, how that interconnectedness may, in some sense, amplify the shock.
Thank you very much. We're going to go now to our WebEx followers and viewers, and we're going to start with GG Press. Please ask your question. Kondo?
Other possible vulnerabilities are, one, we have seen that there's been increase in asset correlation. That means that if there is a shock.
Hello?
Yes, we can hear you.
Yeah, thank you very much for taking my question.
Faster speed and become
like
potentially an
ask
amplifier.
about
Another is incentives going forward.
Can you hold on for a second? So, can you hear? Yeah?
Yeah,
The risk that there will be an incentive to
Okay.
use to boost this.
We're going to restart again.
Finally, is the interconnectedness that Tobias had mentioned.
Can you
between
start the question again, sir?
financial institution and the
I would
corporate.
like to
And
ask
the
a
extent to
question
which if there is
about the potential
a resurgence in stress in
risk of
market, how that
turbulence from the
interconnectedness
upcoming
play in some sense
US
amplify the
presidential election.
Thank you very much. We're going to go now
Yeah,
to our...
thanks very much for the question. So the question was about the upcoming election in the United States. Of course, we don't comment on political developments, and we don't have a view on what is going to happen. But I would note that looking at implied volatility, there's certainly some increase of uncertainty around the election, and that is reflected in financial markets. So, the pricing in general of policy uncertainty is reflected in markets, and that is also true in this particular instance.
Now we go to the second question from Simon Eteba. Please, Mr. Eteba, your question.
Yes, can you hear me?
Yes, we can
Yes.
hear you.
Okay, so thank you for taking my question. This is Simon Atiba from Today News Africa in Washington, D.C. The IMF has already provided almost $31 billion to almost 76 countries around the world to respond to COVID-19 economic crisis. And almost half of that money, 12 to $15 billion have gone to African countries. So my question is, are you, one, worried about debt distress, debt repayment in Sub-Saharan Africa? And also, are you satisfied with the way the money that was loaned to African country was used? It seems like some countries in Sub-Saharan Africa, Nigeria, Ethiopia, that the money did not really go to small businesses or directly into the pocket of the people living in those countries. Thank you.
Thank you very much for your question. So, since the start of the pandemic, the IMF has provided financing to 81 countries at this point. So the number is even a little bit higher than what you mentioned. And the total new financing is about 100 billion, actually a little bit more than 100 billion. PRGT countries, much of which are in Sub-Saharan Africa, received about 21 billion. So this is concessional. And so, as you're pointing out, it is indeed extremely important for this money to get to the right people. And, we are watching very carefully, and we're working very closely with our membership, so with countries in Africa, but also countries around the world, to make sure that all these loans go into the right hands. The program design, how money is distributed, how help is provided is extremely important. And so, we continue to work with many countries in Africa, but also around the world, to really help to improve the situation going forward. I would note the G20 has the debt sustainability, the debt service suspension initiative, DSSI, which has helped many countries as well in terms of coping with this terrible crisis.
Thank you, Tobias. Fabio?
Maybe I can add a couple of points generally in terms of access to markets. So with the global financial condition easing since March and rebounding risk appetite, markets have reopened progressively, starting with investment grade countries and then high yield, for example. And then so the countries with higher rating, they actually had access to markets. They could issue in domestic, in international markets, in our currency, in local currency. When you start going into the more challenged countries, frontier countries, for example, the reopening of markets has been slower. We have seen coming back issuance in frontier in September, for example. So far, the total for the year, it's about 25 billion. Now, one part that has remained close in terms of market access has been Sub-Saharan countries. So since February, the last issue with Ghana, we haven't seen any issue in Sub-Saharan countries in international capital markets. And that could be an issue in some sense of possible distress going forward. So it would be great if the Sub-Saharan countries, in fact, could benefit from the increase in global risk appetite at this point.
Thank you. So we have another WebEx question, and then we go to our online media center. We're going to go to Dua Abdelmonem from Al Ahram Online. Dua, please ask your question.
Good morning for all. Do you hear me?
Yes, we can hear you.
Good morning for all of you. Hope you are doing well and safe. My question is, in light of that, a number of central banks around the globe have adopted a stimulus procedure packages to contain the pandemic impacts. Do you think that introducing more cuts to interest rates in emerging countries, including Egypt, could contribute to enabling the private sector to play a critical role amid the crisis, the recovery phase, and on the post-pandemic phase? Thank you.
Yeah, thank you so much for that question. So concerning Egypt, of course, we have provided rapid financing to Egypt, and then started a program this summer. And we're working very closely with the authorities in Egypt in order to help with the economic policy, as well as providing lending to the country in order to help the country recover from this crisis. As you're pointing out, many countries in this crisis among the emerging markets have eased monetary policy. So the pandemic, of course, went hand in hand with a sharp decline in commodity prices, and particularly oil prices, and that has generally led to a downward trend in inflation in many countries. So with inflationary pressures easing, monetary policy could be eased. And indeed, we have seen many emerging market countries deploying asset purchase programs for the first time. So, countries have not only lowered interest rates, many have also expanded balance sheets via asset purchases. And so that has helped ease financial conditions, that has helped the corporations and individuals in emerging markets to continue to borrow and to continue to have access to credit and to funding. And that has gone hand in hand with the complementary fiscal packages as well, which has helped corporations and individuals. So we have seen that countries that have eased monetary policy have generally seen an easing of financial conditions, so an easier access to financing more quickly. And of course, as you mentioned, the easing of monetary policy globally has also benefited emerging markets, including Egypt. So we have seen that after a sharp pullout of investors out of emerging markets in in the early phase of the crisis, flows into emerging markets, in particular hard currency flows, so flows into, say, dollar-denominated or euro-denominated sovereign debt have returned to pre-crisis levels. And so those funding conditions really have recovered quite strongly. Local government bond markets continue to be somewhat more stressed than at the beginning of the year. But in general, emerging markets have benefited from the return of risk appetite and the easing of global financial conditions.
So if I can maybe add something on the asset purchase in emerging markets, and that's a topic that will be covered by one of the thematic chapters in GFSR that will be released next week. But just to give you a preview of what we find, nearly 20 countries have employed asset purchases in emerging markets. Countries have, there's a wide variety in terms of like scope and tools utilized. So in some cases, those have been focused on sovereign securities, in other cases to private securities, some cases in the private market, in the primary market, some cases in the secondary market, the majority in the secondary market. Our assessment so far is that they have been successful in lowering yields, in compressing term premium, and importantly in lessening some of the strain that we have seen in market. Now, to the extent that this asset purchase will become part of the standard toolkit that emerging markets may use to accommodate, to ease monetary policy going forward, there will be some trade-off to keep in mind there, in the sense of like how the credibility of the institutional legal system in place for the central bank, the extent to which may impair liquidity in the market for these securities. And ultimately, but this is just a sense of what we're going to be discussing. The chapter will be released in more details next week.
Thank you, Doa. Now we go back to our online media briefing center, and we have a question from AFP. Delphine, can you give us more information regarding the weak tail of banks and banking system? Who may experience capital shortfall in this year? Any concrete examples?
Yeah, thanks so much for this question. So in the GFSR, we are not releasing country or institution-specific stress testing numbers. So what we're trying to answer is really whether the system is globally stable. And we do find that at the global level, the banking system is assessed to be able to withstand further adverse shocks. So even if the pandemic lasts longer and further adverse shocks realize, we do assess the global banking system to be stable. But having said that, there is quite a bit of variance across countries. There is a weak tail of institutions in some pockets. So for example, emerging markets tend to have a higher fraction of banks that are likely to be undercapitalized in a further adverse scenario. We also see that non-GSIBs, so the GSIBs, the globally systemically important banks, so these are the largest, the 30 largest institutions in the world, those are generally more stable than the non-systemic banks around the world. We do also point to some regional differences in the Global Financial Stability Report. For example, European banks are assessed to be somewhat more vulnerable than banks, say, in North America.
Yeah, so maybe one point to add is that one of the findings is also that mitigation policy do matter, and so the capital shortfalls with and without mitigation policies in the WEO adverse scenario. So we run the adverse scenario in the World Economic Outlook, and the capital shortfall almost double if we don't take into account mitigation policy. Mitigation policy here being credit guarantees and then a number of capital adequacy measures that have been put in place.
Thank you. We have a question that says, you mentioned in the GFSR the disconnect between the markets and the real economy. How much of this is of a risk to financial stability?
Yeah, thanks. That's an excellent question. So when you look at global equity markets, many segments of global equity markets are back at levels or even above levels than they had been in January prior to the pandemic. And so that is perhaps somewhat surprising because we're in the midst of the biggest economic recession since the global since the Great Depression, nearly 100 years ago. So clearly earnings going forward are lower than what they would have been forecast to be back in January. So the question is, why are the levels of asset prices elevated even though the economic situation is so dire? And so this is this question about the disconnect. And so I think there are two important factors to keep in mind. So one thing is that, of course, equity markets are forward-looking. So to some extent, they're looking through the crisis, and they're not just looking at earnings, say, in 2020 and 2021, but also at earnings beyond 2021, when the economy is expected to recover more and more steadily from this pandemic. Secondly, the easing of financial conditions that is an intended consequence of aggressive monetary policies is, of course, one of the transmission channels of monetary policy. So G10 economies have expanded their balance sheets by more than $7.5 trillion since the onset of the crisis, right? So this is a very, very large balance sheet expansion in those G10 economies. And that has led to an easing of financial conditions, i.e. interest rates are lower, credit spreads are lower, and risky asset prices are higher. And so this easing of financial conditions, i.e. the return of risk appetite in risky asset markets, has allowed corporations and households to continue to borrow, and it has allowed many sovereign countries to keep issuing in markets at favorable rates. So to some degree, the return of risk appetite is an intended consequence of the policies, but of course there's a risk going forward that market sentiment might switch off again if negative shocks occur. So there's both upside and downside risk, and risk appetite we could see some sell-offs, but we could also see a further run-up depending on how the situation evolves.
Yeah, so if I may add, I think there are differentiation here across countries and across sectors, right? So across countries, for example, you've seen equity prices rebound much stronger in the United States than, for example, in the Euro area. You've seen some rebound in emerging markets as well, strong rebound in China. There are also differentiation across sectors. So sectors, they are more contact intensive, more hit by the pandemic, like hotels, airline, financials, as we discussed before, have been hit harder than others, while information technology, communication have been riding the pandemic higher. So if you take those, then think about what are the factors driving equity prices. One is the composition of the indices. So indices, they are more tech heavy, obviously have done better than others. Two, we have seen that the investor base in some countries, the very heavy retail investor base, and that may have contributed to providing support to asset prices. And then the policy support that Tobias mentioned. And that works through the discount rate that is being used to discount future earnings, as well as compressing the equity risk premium. I think the concern is that if there is, for some reason, a trigger that results in a reassessment of risk appetite, and that could be because the recovery is delayed, it could be because the investor reassess the extent of policy, it could be geopolitical risk, like Brexit or something else, then the issue is that whether the repricing in stretch valuation interact with existing vulnerabilities, amplifying the shock. So it's this interaction between stretch valuation and underlying pre-existing vulnerabilities that is the concern from a financial stability perspective.
Thank you very much. We have a question from Rich Miller from Bloomberg. Are investors sensing a permanent change in central bank reaction functions, as indicated by the Fed's new framework? Would that justify the lofty asset valuations we've seen relative to the performance of the real economy?
Yeah, thanks so much for this question. And central bank policies, and particularly monetary policy, are certainly a key focus in this crisis. And I would say there are two aspects to your question that I would like to focus on in particular. So one is the very, very aggressive and very warranted intervention in March and April that aimed at easing monetary policy and easing financial conditions. And we have really seen for at least 30 years that central banks, including the Fed in the US, have intervened when downside risks are rising. And of course, that oftentimes or usually goes hand in hand with a sharp sell-off in asset markets. So, this goes back, for example, to what people call the Greenspan put in the 1987 crisis. There was, in the 1998 crisis that was triggered by the Russian default. There was a policy rate cut, and that continued in 2008. And in this crisis. So whenever downside risks are increasing sharply, which is associated with a sell-off, monetary policy tends to ease in order to mitigate some of those downside risks. And that is certainly appropriate. This is what monetary policy should be doing. And investors are pricing in that kind of behavior. But it's not new in this crisis. It has it has been part of the conduct of monetary policy for many decades at this point. Secondly, there is, of course, a shift in the monetary policy framework that was announced by the Federal Reserve in August. And that monetary policy framework is really focusing on inflation expectations. So what the Fed has announced is that it is going to target average inflation. So that means that while previously the target was about reaching 2%, now the target is about reaching 2% on average over some period of time, so that inflation can be below 2% for some time, but also above 2% for some time. And so that aims at making it easier to achieve the inflation objectives. There were a number of additional announcements that went hand in hand with this framework change, including the way in which the real economy, so which is called the dual mandate, is expressed for the Fed. And so this framework change over time is expected to lead to better performance in terms of hitting the inflation target.
Yeah, so maybe one only thing to add is, to the extent that there might be unintended consequences from the policy and the objectives, it's important from an intertemporal standpoint to be aware of the benefits of today's policy intervention and what comes out of the framework with what could be unintended consequences in terms of building up of financial vulnerability. So the importance of using, for example, macroprudential tools should vulnerabilities build up as a way to address such vulnerabilities.
Thank you. We have time for one more question. Given the severity of this crisis, do you think regulators globally should ramp up the rules?
Yeah, thanks very much for this question. It is certainly going to be a key question going forward. We haven't seen the end of this crisis. While some economies have started to recover and financial markets have come back to some extent, we are far away from a full recovery. So it's too early to draw final conclusions, but we can certainly make some preliminary observations concerning financial regulation. So first of all, let's think about the banking system. So the banks went into this crisis with higher capital and higher liquidity. And in our assessment, globally, the banking system is safe even if there are further adverse shocks. So that is a huge success. So the fact that the banks have had so much more capital than in the 2008 crisis has meant that these adverse financial feedback loops that were so prominent in the 2008 crisis were more or less absent in this crisis. There was a sell-off in March, but that was arrested very quickly. And so the combination of aggressive monetary policy and the higher capital and liquidity on the banks really have helped to mitigate the macro-financial stability concerns. That's number one. Number two, there's a lot of thinking around the usability of buffers, because of course capital and liquidity buffers are on the bank balance sheets to be used in times of crisis. And so for the first time in this crisis, some jurisdictions had built up a counter-cyclical capital buffer. So this is a macroprudential capital buffer that was released at the onset of the pandemic in many countries. And so that is one part of usable capital. But there are other parts of usable capital, and we will see over time how much both the capital and liquidity buffers will be used and are usable. So that will certainly be something to look at in the future. Secondly, in terms of banks, of course, the stress tests have played an important role. So supervisors around the world are rolling out more and more COVID-specific stress tests, and that is a very important tool for regulators to assess intertemporal trade-offs in between using capital today to allow banks to lend today and support economic activity while preserving financial stability going forward. So the role of the stress tests is certainly notable. And then, of course, I already mentioned some of the issues in the non-bank financial sector. So in the non-bank financial sector, we did see certain vulnerabilities come to the fore in April and March and February this year. So money market funds and money markets in general dried up and were vulnerable. In treasury markets, in the benchmark securities such as US treasuries, bonds, JGBs, and gilts, there was a kind of dash for cash which generated market illiquidity in those segments, which is certainly something to worry about. And there was, to some degree, a margin spiral where margins increased in some segments of the market, which forced investors to deleverage very sharply, and this fed back into an acceleration of the sell-off. The central bank stepped in many markets and arrested the sell-off, but there are certainly some structural weaknesses that regulators are going to look into going forward.
Any follow-up?
Maybe two quick ones. One is making the point that we've been trying to make so far about these unintended consequences. So to the extent to which the very low interest rates are expected to be very low for a very long time and compress volatility, incentivize investors to take on more risk, whether this is duration risk, credit risk, use financial leverage. It's very important that we continue to monitor the build-up of this risk. And in fact, it would be great to have better, more robust data. So even almost 15 years after the financial crisis, we are still in a situation where in some segment of financial markets, there's not many data available to supervise and regulators to assess risk. And then number two, generalizing what Tobias was saying here, the need for consider whether regulatory perimeter around non-bank financial intermediaries needs to be broadened and whether we have enough macro-potential tools to address these vulnerabilities.
Thank you very much, Tobias. Thank you, Fabio, and thank you to our followers. We are very thankful for your following us on IMF.org. We have the press briefing tomorrow for the Fiscal Monitor and the opening press conference for the Managing Director. So we see you online tomorrow. Thank you.
Thank you very much.
Thank you very much.